Focus. Ideate. Innovate. Enable.
The National Stock Exchange of India has been actively involved with initiatives to educate the young generation of our country on the importance of financial management. One such initiative is NSE FinWiz that focuses on educating and advising the young workforce of the country on wealth management to enhance financial literacy and to empower
Insurance
them.
is for protection and investment is for growth.
Another program facilitated by NSE IPFT is NSE Financial Quest. This inter-school financial quiz contest goes an extra mile by educating the young students on fundamentals of finance.
On the buzzer, what is this? It's the formula for the simple interest. Simple interest is the right answer.
Under the NSE Financial Quest Base Camps banner, the program engages students around the year through workshops on various topics, projects, interactive videos and quizzes.
DiCaprio is bouncing checks of Pan Am.
Plus 75 on that. Plus 75.
To facilitate these two programs, NSE along with CNBC TV18 has travelled across the country to bridge the wide knowledge gap in terms of finance. In this episode of NSE FinWiz, we are all set to achieve our objectives once again by gauging young professionals in a new city.
Hello and welcome to Season 4 of NSE FinWiz, powered by CNBC TV18, and I'm your host, Nitya Balakrishnan. Today my team and I have travelled to Gurgaon, to one of India's leading tyre manufacturing companies, Apollo Tyres, Gurgaon. Apollo Tyres came into inception in 1972 and has been a trusted name in the business of manufacture and sale of tyres. With its corporate headquarters in Gurgaon, the company caters to over 100 countries across the globe. With multiple manufacturing units in India and the Netherlands, Apollo is in the process of setting up its 6th manufacturing facility in Hungary. NSE FinWiz visited the headquarters of Apollo Tyres in Gurgaon, along with the experts, to gauge the thoughts and notions of its employees on personal finance, with the theme Dreams Come True.
I think this is a very good step to inculcate and impart knowledge to the young professionals. It starts at least all of these people thinking on saying what their current notions are, what they are investing, is those wise decisions. And also the setting being an informal one raises an atmosphere, one where one will listen to it, think over it, and I think hence it's a very good initiative.
I've done very basic investments, like I've gone in for a pension scheme because my parents retired recently actually, and that prompted me to do this because I realized working in a private sector, I wouldn't have any pension 30-35 years ahead. And then also for the tax saving and yearly that we do. So for that I invest in my PF, making sure that my money is multiplying, and then also I'm saving on taxes.
Short term would be investing in the mutual funds. I'm planning to invest in the near term, and medium term would be owning a house. Long term, I wanted to focus on purchasing my own farmhouse so that I can use it as an investment option.
So I'm a great propagator of asset management, asset building. I have invested in an asset which I currently use. That is, I feel, one of the good tools to have because of the appreciation it gets over the period of years. Nothing other than this. I would want to hear from this workshop, this interactions today itself, to see whether or not there's some value add that can be done.
Hello and welcome to Season 4 of NSE FinWiz, powered by CNBC TV18, and I'm your host, Nitya Balakrishnan. Today we're in the campuses of one of India's leading tyre manufacturers, Apollo Tyres, here in Gurgaon, and I'm joined by two very special guests, Mr. Tanveer Alam and Mr. Ankur Kapoor. Thank you so much for joining us on the show. Without further ado, let me talk about how important it is not just to make your money, but multiplying money. And Mr. Alam, let me come to you first. In India,
is this constant need to multiply your money something that's at the back of every investor's head? Or are we just, very comfortable setting it aside in terms of fixed deposits or savings accounts? And, my money is safe where it is, but I don't really think of wealth creation in that sense.
Traditionally, India as a community, as a country at large, we've had a very high savings rate. We have in excess of 30% savings rate in the country. So we save a lot. But bulk of this investment or savings, as you might say, lies still in the conventional way of fixed deposit or life insurance product, a gold and real estate we have seen. So if you start investing, you will see this huge amount of wealth gets created. And there is only one fundamental rule of wealth creation, and that's called the simple power of compounding. If I ask you a simple question, which is more, 5 raised to the power 10, means 5 multiplied 10 times, 5 into 5 into 5, 10 times, or 10 raised to the power 5, 10 into 10 into 10, 5 times. Which number is more? 5, right? It's not the return, but the exponential growth comes from the time horizon, and that is what, if you go and reflect to the power of compounding formula, is amount equals principal within bracket 1 plus r, the return raised to the power n. That's the exponential return comes from the time horizon of investment and not from savings. Coming back to the conventional product, if all the conventional product that our parents used were invested over a long-term period, whether it's PPF or LIC you look at, or even real estate for that matter, they were all investing for 10, 15, 20 years. And that was the root cause of wealth creation, not the product alone itself.
Fair enough. When you talk about, your EPF, your NPS, these are things that people have always been investing in. Whereas when you talk about new age forms of investment like the equity markets, there is that fear of volatility and, whether the markets are going to crash, etc. How does one address these concerns of the investor, especially as we're sitting at a time when very recently the government has gone ahead and reduced rates for the ETF?
Sure. Well, whenever you're thinking about investing, think of two traditional asset classes. One is bond, the other is equity. As Nitya, you mentioned about PF, NPS and so on, these products would very well fit into the bonds category, which is directly linked with the interest rate in the economy. If the interest rate is going down, so will the interest on the PF. For example, the interest rate on PF has gone down to 8.6% now. And when it comes to equity, the traditional classes, in India, I would say, equity and real estate, these are two classes which are like growth assets. So whenever you are investing into growth assets, for example, equity, you would always have a long-term horizon and it will always see short-term volatility. You need to just accept that there would be short-term volatility. There may be notional short-term losses, but not the real ones. But over a long period of time, if you stay invested in a diversified pool of equity, you tend to create wealth.
Absolutely. When you talk about investing and wealth creation, what foremost comes to mind? Because if I need money for, say, something right away, I'm looking at, buying a car right now, maybe do not want to take a loan. So how do I plan for something like that vis-a-vis, a house of my own, say, in 10 years, vis-a-vis a decent retirement corpus when I'm looking to retire? How do you target that form of wealth creation?
Very good question. In fact, like Ankur touched upon risk. See, when you are investing in an equity market for a period of 1 year, there is only 60% probability you will make money. If you extend the horizon to 3 years, the probability increases to 78%. On a 5-year basis, 85%. On a 10-year basis, 100% of the time you would have made money. That is what time horizon does. It actually mitigates or reduces the risk of investing in equity market. So, when you're saving or investing for a long-term goals, choose equity mutual fund as asset class. If you're investing for short-term goals which you want to fulfill within 2-3 years time, you have a bouquet of bond funds. It could be a short-term bond fund or medium-term or long-term bond funds. If you're investing for a period of 4 to 5 years or 6 years, it is best advisable to pick a balanced fund. Okay? And as you move closer to your goals, just ensure that you move towards a less risky asset class like bond as you move closer to your goals. If you follow this simple thing, nobody can stop you from becoming rich.
But on that note, it's time to slip into a quick breather right here on NSE FinWiz. But stay tuned, a whole host of queries answered on equity markets on the other side. Hello and welcome back to NSE FinWiz powered by CNBC TV 18. We're in conversation with Tanveer Alam and Ankur Kapoor here at Apollo Tyres in Gurgaon. And without any further ado, let me throw the spotlight directly onto the equity markets. Now, Mr. Kapoor, if I can ask you, what are the top 3 rules that you have to keep in mind when you talk about investing into the equity markets? And how do you go about? What are the routes to take in the equity market investment?
There are 2 things to it. What kind of exposure you are getting to the equity market can be a direct exposure, that is investing directly into the stock market, or it could be through a fund, or it could be even an exchange fund or mutual fund, right? In an exchange traded fund or a mutual fund, there is a company and people involved who will be investing the money on your behalf. In case of an equity mutual fund, there would be a fund manager who would do the right things and select stocks for you. And they have their own methodology in terms of where they are investing. But usually they are all long-term based and not a trading kind of strategies. However, when you are investing into equity market directly, well, first of all, you should refrain yourself unless you have a lot of time doing the research. And we are not talking here about the trading mindset, we are talking the investing mindset. Well, 2 or 3 things you can look at in terms of which all companies you can invest in. So one of the things would be what is the return on equity, so that it is always more than the cost. So something like a return on equity more than 15% should be the first criteria. The second criteria would be less of liabilities borrowing in the company. So less, debt to equity ratio of less than 1. And the third criteria, which I would say, is the growth, how well the company is growing. So growth of 10% should be the third criteria. Once you're done with that, the level 1 is done. The first step is taken. After this, the entire exercise starts in terms of, comparing the companies with the peer set, then refining the numbers and so on and so forth. So it's a long drawn study that you need to do.
Fair enough. We have Nitin Mittal from the accounts department here, Tanveer, whose query is, how do you plan for a steady and less risky return, even while investing in equity markets, as comparable to bank FDs? So if I can have Nitin Mittal, please.
At times, our perception may not be right. Just perceiving that the equity market or equity is wrong, is risky, may not. The risk which you are actually not seeing, which is hidden, is the inflation risk, the cost of living which is going up, which is not visible to you, you are actually omitting that. That is the bigger risk. The risk of not investing is a much bigger risk than the risk of investing. 1. Yes, I do understand if you are starting for the first time, it's like I learned swimming with my son. Okay, I could stand up in the pool with my head over it, but I was still scared. And believe me, he learned faster than I could do. And that's reality. Kids learn faster. Because I had a lot of fear in my mind. So my only submission would be, get started. But there's a wise saying which says, if you're testing the depth of water, don't put both your feet down. Start small. Start with a small sum, get used to it, and then gradually. It's like swimming. Once you learn swimming and you know how to swim, you'll enjoy it. And then you'll never go back to this investment like we have graduated that way. And trust me, it's not all that difficult.
All right, we have an interesting question here, Ankur, from a couple of people. And the question is there a difference in risk and returns between shares of companies which are part of an index than those that are not?
Well, there may or may not be that difference. Just to point out that Nifty 50 will have top 50 companies in India by market capitalization. So there may be, there are a lot of companies that are not part of the index. And within the index also, index will just deliver you a return which is in combination of all these 50 companies. There would be few companies that have performed well, and there would be few that have not performed well. And as the company, even a small company grows, it becomes small to a mid-cap size, and from a mid-cap size, it enters the index. So the blue chip stocks that we talk about are actually part of the index. What I believe is any company that is part of the index will not perform drastically different from the index unless there is some sector level change. So it will just have an average. The reason for that is a lot of institutions are investing into the index funds. The money is actually flowing into the index fund, right? So that is why the small cap and the mid cap space is left, where you would have seen companies like Eicher Motors who have grown from 22 rupees to 25,000 rupees over last 15 years. So there would be those examples, but rightly pointing out on the index fund, I do not believe that there may or may not be the difference, but there is no standard answer to this, that there will be.
All right. We've learned about the A to Z of investing into the equity markets, but time for another quick break right here on NSE FinWiz. Stay tuned. In conversation with our financial experts here at Apollo Tyres in Gurgaon, and it's time to throw the floor open for questions. If I can ask members of the audience to please raise your hands, identify yourselves, and pose a question to one of our financial experts, please. Any questions out there? Yes, can we have the microphone to the gentleman, lady in white, please?
Yeah, so we have been talking about mutual funds and equity. My question is that if we have a 20 years horizon and we shortlist some blue chip equity shares and we just buy them and keep it, so what would you recommend? Doing that is better, or investing still into mutual funds is better for a 30 years horizon?
If you ask me a blanket approval, blanket questions, yes, I would still favor mutual fund. But having said that, buying a good blue chip stock which you think can survive for the next 20-30 years could be a good wealth creation as well. But having said that, you have to monitor that. A lot of good quality stocks, for example, may not have created wealth over the long term period. So like he says, a good stock can enter a Nifty basket, a lot of falls out of the Nifty basket as well. So if you can do that monitoring, by all means do it.
I'm Namrata. I'm part of costing team, and I wanted to ask that in which sector in equities shall we invest, as demonetization has already affected many sectors. So what's the right sector now to invest?
First of all, unless you have a very good competency in terms of understanding the sector, you should never take sector exposure. Sector exposure requires you to have a very deep understanding of that industry. So I would suggest have a diversified portfolio unless you are a sector expert, and that could be in terms of direct equity or in terms of mutual funds, but have a diversified portfolio. In the current situation, it will be not the right thing to point out which particular sector to invest in. That will be more like a trading kind of call, and I would not at all suggest going that way.
Well, on that note, we're absolutely timed out on this edition of NSE FinWiz. Tanveer and Ankur, thanks so much for joining us on the show. And from all of us here at Apollo Tyres, it's been a pleasure. Thanks for watching and have a great weekend.
It was a great experience for me for attending this session of FinWiz. Now I'm pretty much clear about my doubts on mutual funds, equity, bonds and paper gold. And now I can rethink about my investment plan, my decision, and would like to invest in these sectors. So I would like to thank CNBC and Apollo for giving me a chance for attending this session. Thank you. Thanks a lot.
Today was a very interesting session for me because I used to belong to the category who used to get scared about all the words mid-cap, mutual funds and all. But now since the financial advisors have implored upon the the options, what we can invest. So I am also, moving towards that direction wherein I can also invest some money and I can, not park all my savings into one account, into one basket, but I can, employ the option of savings into different kitties.
So the session was very, very informative, gave us good, valuable insights into the various investment options available. And I think everybody learned a thing or two new today. So thank you very much.
Focus. Ideate. Innovate. Enable.